It's a special day here in Nigeria. It's MPC Decision Day, the first one for 2026. The CBN and the MPC members started the meeting yesterday. Today we expect to hear what they have decided to do with mostly interest rates in the country, and will drive the conversation towards the decision announcement later on the program here on Business Incorporated. I'm Ini John McPapa. Let's start with our usual business. We start from oil prices. We're hovered near 7-month highs today. Traders are assessing risks to supply from any military escalation, as another round of U.S.-Iran nuclear talks is very close to us. So for this afternoon, we see the numbers are in red: 0.80% for Brent, $71.27 a barrel. WTI is also that, but you would notice that while Brent has lost close to 1%, it's less for WTI, which is from the United States. The WTI is from the United States, and it's just down 0.14% at $66.22 a barrel. Brent is trading at its highest since late July, while WTI is at its firmest since early August. Iran and the United States will hold a third round of nuclear talks on Thursday in Geneva. Oman's foreign minister disclosed this. And the United States wants Iran to give up its nuclear program, but Iran has adamantly refused, and they've denied that they're trying to develop an atomic weapon. The State Department is pulling out non-essential government personnel and their families from the U.S. Embassy in Beirut, according to a senior State Department official. So this is amid growing concerns about the risk of a military conflict with Iran. U.S. President Donald Trump said yesterday that it will be a very bad day for Iran if it does not make a deal. And all of this is pointing towards Thursday, when that meeting is supposed to hold. So we keep our fingers crossed and hope for the best. In the metals market, gold prices fell more than 1% today, easing from a 3-week high that it hit earlier in the session. A stronger dollar and profit-taking weighs on prices, while investors are waiting clarity on the U.S. President Donald Trump's tariff plan. So we see spot gold is down 0.61%. The price is $5,193.70. Spot silver is on the flip side at 1.63% in the green, $87.99. Platinum is green at 0.86%, $2,171.10 per ounce. Palladium is 0.3% in the green, $1,782.50. And copper, copper made a huge recovery today. So we've seen it at 1.36%. It seems like losing a lot of gains has also attracted investors to it. So that's why we see a lot of buying interest, and that has brought the price back to $5.85, up 85 cents per ounce. Now, as we speak, members of the Monetary Policy Committee of the Central Bank of Nigeria are meeting, continuing their conversation from yesterday, and in a few moments we expect to hear the announcement for that. Ahead of the much-anticipated announcement, the chief economist of the Development Bank of Nigeria, Professor Joseph Nana, says that he expects that the Monetary Authority will cut moderately and cut the benchmark lending. He was on Business Morning earlier today.
There is a degree of apprehension to hold in this meeting for today. The markets have it as a cut, maybe 50, 100 basis points at best. But for me, I would really consider this part of the equation, which is, if you will, last week, I believe, February 17th, 18th or so, the central bank performed an open market operation and SDF, the Standing Deposit Facility, to the tune of 3.5 trillion naira was mopped up. Banks took advantage of the SDF, and it was sterilized at around 22.8%. So that in itself tells me the excess cash in the banking system was already mopped up. Dare I say, that's a quite expensive mop-up for the central bank, because it puts a significant fiscal cost I believe the last time I saw the report, it was around, I forget the number, but the cost implication is in the trillions. So in my mind, there's a school of thought that says you need to cut because it boosts and gives confidence to the market and give confidence to the banks to lower rates so that households and micro, small, and medium enterprises can now begin to get more funding at a lower rate, which will help boost growth and productivity for the country.
So will it be a cut? Will it be a hold? I mean, I've seen some reports saying that Nigeria can expect one of the highest cuts. I think Bloomberg put it, or analysts in Bloomberg put it about 150 basis points. FDC expect about 50 basis points. CPPE expect a hold. So it varies, but we're going to delve more on that. But first of all, let's look just around us on the continent and see what other countries are doing at this time. We'll have Will Ibong. I know you saw her in the morning, Will. I can't remember the last time I was on set with you in the morning.
Oh, yes, it's really,
the night bird you are.
Oh, the night bird. I did tag like the night vampire walking around here.
But anyway, so you want to tell us what's going on in other countries?
Definitely. We're just going to break down what's happening in major economies that we track in Africa, especially with their inflation and interest rates, and seeing the signals that are coming from the central bank and what to expect going forward. So we're just going to be talking about that. We see policy data across 5 major African economies. What does this mean for the context of the global economic trends? Starting with South Africa, we see inflation eased slightly to 3.5% in January. I see that number there really now down from 3.6% in December, and it's comfortably within the Reserve Bank's target, and is the lowest average in decades. Now, this continued moderation in inflation has strengthened expectations that the South African Reserve Bank may begin cutting rates at its next MPC meeting as price pressures remain subdued. And we say forecasting, even analysts are forecasting around 25 basis points cuts later this quarter if inflation stays on this path. Also, we've seen that rand strengthening, having a strong run, but traders are not optimistic. They think it may slow down or pull back very soon, especially if economic news is negative. Now, looking at Angola now, let's move into Angola. We see inflation is still elevated at 14.6%, and that's lower than the extreme levels seen in 2024. But price pressures, especially in food and energy, remain a factor. And the National Bank of Angola has been gradually lowering interest rates, the policy rates. I'm seeing recent policy commentary from analysts suggesting that more reductions could continue through 2026 as inflation continues to moderate. Now in Ghana, we see that inflation fell sharply to 3.8% in January 2026. That's marking the 13th consecutive month of declining price growth. Now this is now below the central bank's target range, creating room for potential rate cuts when the Bank of Ghana meets next. That's in March. Now in January, the Bank of Ghana has slashed interest rate to 15.5%. That's about 250 basis points to settle at 15.5%. Meanwhile, observers see the sustained easing, given the weak price pressures across goods and services. Probably more cuts to come from Ghana. Let's look at Kenya now. The headline inflation, that hit about 4.4%, sitting right there. That's near the lower end of its target band. That reflects also a slower pace of price increases and as compared to last year when inflation was consistently in the mid-range. Now on February the 10th, the central bank lowered interest rate by about 25 basis points to 8.75%, and now this marks the 10th consecutive rate cut as the central bank aims to stimulate private sector lending amid easing inflation. Now with inflation contained right now, the Central Bank of Kenya's MPC may opt when it meets in April to hold or cautiously ease policy if this trend continues. Now finally, Nigeria still has some of the highest price pressures we've seen on the continent. Inflation at 15.1%, but it is slowly declining from previous months. Now this persistent disinflation we're seeing in Nigeria has strengthened market expectations. And you mentioned earlier, we're expecting from Bloomberg 150 basis points, FTC 50. But the Central Bank of Nigeria could cut the monetary policy rate slightly at its meeting today, which really analysts are keeping an eye out. Markets are expectant, but we've seen that split. In analysts, as I mentioned, many are expecting 50, 100, but inflation, if it continues to trend down, we might see the central bank continue to ease depending on global effect. Now, across Africa now, we're seeing a split. Countries with low inflation can think about easing, while high inflation economies, just like Nigeria, Angola, we see some of them, must stay tight a little bit longer because of that, what we're seeing there. Now, moving on to other, globally now, the story is similar. We're seeing in advanced economies like the United States, the UK, and the Eurozone bloc, we're seeing that inflation has cooled, but the central banks have hinted at pauses or possible rate cuts after earlier tightening. But there's a twist here. New inflation tariffs by Donald Trump are creating uncertainty, and that the market does not like. Tariffs can raise import costs, it can push up prices globally, and make central banks more cautious about cutting rates too quickly. So the big takeaway is simple. Inflation is falling across many economies, we're seeing that, but interest rates may stay high for longer because of global risks, from trade tensions to currency pressures. And that's the balancing act facing central banks in Africa and around the world right now. And so you need to basically, one of the things we're going to be looking at now is how do central banks in Africa keep prices low and while contending with trade tensions, geopolitical tensions, and possibly the risk of maybe if the inflation in the US possibly goes up, how does that affect Africa, who is mostly dependent on the US dollar?
Yeah, well, it's a very, like you talked about, the act of balancing there is going to be very sensitive. So just when inflation is declining in most countries, most economies are experiencing that, then we hear the tariff battle again, and we know what that can do to not just emerging economies, even Europe is facing it.
Definitely.
The German auto industry has been hit.
South Korea is also,
taking
the back whip, saying that they have to follow, the decision they made or the deal they had with the US last year.
Exactly. So I mean, it's a lot of balancing to be done. But I want us to notice here. Look at. I think the miracle of Africa this time is Ghana.
It's Ghana.
They went from about 40%
to about 3.8%.
I don't know how they did it, but I know that they did something about
IMF,
their gold.
Yes, and they also
did something about their gold. Yeah, they did the debt restructuring, which put them in a very tight corner, protest and all of that. And then they moved their reserve to gold. And it was locally produced gold. So I think that really helps them.
Ghana is a gold-rich country, so you can't expect them
Nigeria is an oil and gas-rich country. Nigeria is an oil and gas-rich country. Oh, but look at that.
15.1%. But it's continuing to decline, and we're looking at if this trend continues, we'll probably see that softening in terms of other areas, and probably we still have the highest interest rate there, 27%.
Yeah, I mean, we have the highest inflation, so we should have the highest. But for the first time in I think maybe almost 10 years, we have a single-digit food inflation,
which is a good one. We should celebrate that.
So I'm wondering when you go to the market if you remember that. That's what I'm wondering.
Oh well, I think I'm going to the market today, so I'll probably see how much money I'm going to spend.
Okay, all right, okay. But I mean, expectations. I mean, I was surprised actually when I saw the Bloomberg analysis saying we should expect about 150.
Oh, that's quite steep and quite high compared to what analysts in Nigeria expected, 50 to 100 basis points.
Don't forget, this is a pre-election year. That is also a factor.
True.
When you're dealing with inflation and money in circulation, because we know what politics means.
A lot of money going around
in Nigeria. So I mean, yes, we're having a decline now. We're celebrating that, but we have to be cautiously optimistic.
You know that the central bank governor last month, I think, did warn the executive
impact of that.
To not spend money during the elections. Well, to curtail the spending of money, which could turn.
Listen to that,
goodness, I hope they're going to listen to that, because that could change the steady growth we're seeing right now, the stability we're seeing in the economy. If that comes, if we have high liquidity right now, that could destabilize everything the central bank has been building so far.
And I believe that is going to be a major consideration for the MPC. So if they go ahead and cut now,
might be too soon.
Yeah, it might be too soon, because you might just have those political spending coming in and the impacts that it usually comes.
So what are your bets on, Ini? Are you thinking that the central bank is going to hold?
I'll let my guests discuss that with you. Thank you so much for taking us through. So yes, we're going to have our guests join us in just a bit. But I mean, it hasn't been all bad for Nigeria's monetary authority. We've had some gains, and that's why we've been showing you this. And we're going to show that to you now, just before we hop into the main conversation ahead of the MPC announcement. Where we are waiting the central bank governor to join, of course, and make that announcement from the central bank headquarters. And of course, we're here to capture that live. And I believe that the chairs will be filling in real soon to welcome members of the committee and all the stakeholders in the MPC, the CBN. There you have it, just at the corner right there. The chairs are pretty much more empty chairs we have now. But in a couple of minutes, we know, I mean, looking at precedents, the CBN governor would normally come out just a few minutes before 2 o'clock. There you have it. I believe that's the governor. Oh, that's the governor even coming in right there. Looks like we're going to start a bit earlier. Just before the CBN governor will start talking, Mr. Mukhtar, do you agree with Mr. Teriba?
I don't know whether it's going to be like he said, demolition.
That sounds really harsh.
Yes, I think we have no option but the court. Last time when they met towards the end of the year, people were expecting them to do a court, but I said it, I think, with your colleague, and I said, we'll have a whole. Now, because at that time, it was fragile. The economic situation was still fragile. We still have the effects in a corridor of stability. Today is 150. Tomorrow is something X. But at the time, as it is now as we are, like he said, you can't see any reason why there shouldn't be a court, unless...
What about the political spending? This is a pre-election year.
I'm going one way. Unless they are saying that the data we have on ground is not in tune with reality. Now, when it comes to political spending, I always tell people that when it comes to political spending in Nigeria, it's not so much of the naira in circulation. That's what we don't know. The politicians don't come out to stack the naira. They have the dollar that they are bringing out to change to naira. That again is again. And then when you talk about spending during the political era, you are looking at a vibrant sector that is always liquidity driven, and that is the informal sector. They tend to gain more. The printer, the market woman, the woman that is going
to sell. Doesn't that feed into inflation?
When you look at that inflationary figure, you ask what's the key driver of Nigerian inflation? It's not the price, supply, demand. It's FX challenges that we have. The cost of production, cost of goods and services, largely driven by exchange rate volatility. Because if we are not what we are consuming, if we are not eating what we are, if we are not producing what we are consuming, sometimes the machinery to put it into a finished product we have to import. So anyway, anyhow, you have that FX challenge. Then the insecurity also comes in terms of the farmers being able to move their goods from point A to point B. So for me, yes, the political areas will be there, but as it stands now, we are not seeing the primaries. We are only seeing maybe they are doing local government. So we have not gone to that point where the primaries will come and you see a lot of liquidity. And as it stands, if you look at the political atmosphere as it stands today, there may not be so much liquidity to change the narrative during the primaries. Maybe we may be looking towards the main election. Because again, when you look at the election, permutation and everything, when you have the ruling party that have over 36 government,
exactly.
I don't know what you are
going to... We don't have a lot of opposition these days. You don't have a lot of
opposition that you are going to be giving things. So for me, I think the CBN will have a lot of explanation to make
if they don't cut.
Okay. And just this morning, I'm reading from one of the dailies saying the CBN is even mopping up naira to the deal because it doesn't want the dollar to continue to go down. So that's the pointer that we have so much that we are actually thinking we want to attract more foreign portfolio investors or foreign direct investors into the Nigerian market. I have never seen a situation whereby the naira becomes one of the golden currency now, because even for investors now, you tend to hear everybody say, look, I have dollar, I want to change it back to naira because the price is coming down. So
that's good news. But Mr. Teriba, I mean, you are very big on the achievements of the Cardoso-led administration at the central bank. We've seen price stability, we've seen GDP, we've seen the reserve also, and these for you show that perhaps we're on the right path.
Well, big on the achievements of the government led by the CBN with the successful reforms in the foreign exchange market. And I would like to emphasize, when we speak specifically about the Monetary Policy Committee, much of the threats that they confronted 2 years ago were external to the monetary policy process: foreign exchange crisis, fiscal crisis, with consequence, for the challenge of monetary policy stabilization. Much of that threat has cleared, and much of that credit, most of that credit are also extraneous to the MPC. So with regards to the business of the MPC, monetary policy management, okay, the threats that you were scared of are no longer there. And the instability of the exchange rate, the acceleration of inflation are now in reverse. Exchange rate is stable and strengthening, as he says. Inflation, rather than accelerating, has been decelerating now for 14 months.
We have food inflation in single digits.
Food inflation in single digits, yeah, from 40%.
Oh, okay. Sorry, Mr. Terrible. I believe the governor has started speaking. So let's join the live broadcast and hear the announcement.
MPC of the Central Bank of Nigeria, CBN, held its 304th meeting on February 23rd and 24th, 2026. The committee reviewed key developments in the global and domestic economies, as well as the outlook. 11 members of the committee were in attendance. Decisions of the MPC. The committee decided as follows. 1, reduce the monetary policy rate by 50 basis points to 26.5%. 2, retain the standing facilities corridor around the MPR at plus 50 to minus 450 basis points. 3, retain the cash reserve requirement, CRR, for deposit money banks at 45%, merchant banks at 16%, and 75% for non-TSA public sector deposits. The committee's decision was premised on a balanced evaluation of risks to the outlook, which suggests that the ongoing disinflation trajectory would continue, largely supported by the lagged transmission of previous monetary tightening, sustained exchange rate stability, and enhanced food supply. Considerations. In reaching this policy decision, the committee took into account the sustained deceleration in year-on-year headline inflation in January 2026, marking the 11th consecutive month of decline. This downward trajectory in inflation was driven mainly by the continued effects of the contractionary monetary policy, stability in the foreign exchange market, robust capital inflows, and improvement in the balance of payments. The momentum was further reinforced by relative stability in the prices of petroleum products and improved food supply conditions, especially staples. These outcomes have indicated that prior tightening has continued to anchor expectations. The MPC particularly noted the remarkable performance of Nigeria's external sector, evidenced by the robust accretion to foreign exchange reserves, supported by higher export earnings and increased remittance inflows. This has contributed to greater stability in the foreign exchange market and bolstered investor confidence. Members also welcomed the newly issued Presidential Executive Order 09, which redirects oil and gas revenues into the Federation account. The committee acknowledged the potential impact of this order in improving fiscal revenue and accretion to reserves. Given these improved macroeconomic conditions, the committee believed that a moderate easing was consistent with the prevailing inflation dynamics. Members acknowledged the continued resilience of the banking sector, with most of the key financial soundness indicators remaining within regulatory thresholds. With regards to the ongoing recapitalization program, the committee noted that of the 33 banks that have raised additional capital, 20 have met the new minimum capital requirement, reaffirming steady progress towards a more robust and well-capitalized financial system. The MPC reiterated the strategic importance of the recapitalization exercise and urged the bank to ensure its successful completion. This would reinforce financial system resilience and enhance the sector's capacity to support sustainable economic growth. Price and other domestic developments. Headline inflation year-on-year eased to 15.10% in January 2026 from 15.15% in December 2025, reflecting a moderation across both the food and core components. Food inflation declined markedly to 8.89% from 10.84% over the same period, supported by improved domestic food supply, sustained exchange rate stability, and favorable base effect. Similarly, core inflation declined to 17.72% from 18.63%, driven largely by moderation in the average prices of information and communication services. Month-on-month, headline inflation declined to minus 2.88% in January 2026 from 0.54% in the preceding month, indicating a continued softening of price pressures. In terms of output, The Purchasing Managers Index, PMI, stood at 55.7 points in January 2026, reflecting continued expansion in economic activities and likely improvement in output in the fourth quarter of 2025. Gross external reserves rose significantly to $50.45 billion as of February 16, 2026, the highest in 13 years. This provides an import cover of 9.68 months for goods and services. Global developments. Global economic activities are projected to strengthen in 2026, underpinned by progress in trade negotiations, increased investment in artificial intelligence-related technology, and gradual monetary policy easing. Notwithstanding this projection, significant headwinds remain, including rising protectionism, deepening geo-economic fragmentations, and the likely escalation of trade disputes. Global disinflation is anticipated to continue in 2026, driven by the lagged impact of previous monetary policy tightening, further resolution of supply chain disruptions, and improved stability in commodity markets. Near-term inflation is, however, likely to remain above historical averages, constrained by structural rigidities and divergent pace of disinflation across several economies. Outlook. The outlook indicates that the current momentum of domestic disinflation will continue in the near term. This is premised on the lagged impact of previous monetary policy tightening, sustained stability in the foreign exchange market, and improved food supply. However, increased fiscal releases, including election-related spending, could pose upside risks to the outlook. The MPC reaffirmed its commitment to an evidence-based policy framework firmly anchored on the bank's core mandate of ensuring price stability while safeguarding the soundness and resilience of the financial system. The next meeting of the committee is scheduled for Tuesday 19th and Wednesday 20th May 2026. Thank you.
Thank you. That was communique number 161 and the first one for the year 2026, presented by the chairman of the MPC and the governor of the Central Bank of Nigeria, Mr. Olayemi Kadusu. We'll now take questions from members of the press. Please, if you're selected, just your name, your medium, and one question. Thank you.
Good afternoon, Mr. Governor. Good afternoon, everyone. My name is Musa Ubakar with NTA. My question is, Governor, Nigeria net foreign reserves reportedly reach $49 billion. as of February 1st, 2026. Now, what are the key drivers behind this build-up, and how sustainable is it over the medium term? Thank you.
Thank you very much. Just a point of correction there. These aren't net reserves you are quoting, it's the gross reserves. And the gross reserves, as at middle of February, is about 50.4 billion, which, as I had said in the communique, is the highest figure that we've had in 13 years. Now, we will, in the fullness of time, be saying something in the next few days or so. We'll be breaking down the net reserves figure to give you a better feel for how that has moved over the past few years. So the gross reserves is actually 50.4 billion, and it is the largest that we've had in the past 13 years. Now, your question basically is, what are the key drivers on this, and to what extent is this sustainable? And the answer is, of course, we've seen very positive signals with respect to the way the macros are developing. There have been favorable trade developments. The current account is in healthy surplus. And of course, the non-oil exports have also gone up respectively. It's something I talk about all the time, which is the issue of the diaspora remittances, which again is going up very respectively indeed. Of course, with all this and underpinning all this, quite frankly, is market confidence. Without market confidence, no matter what you do, you will find you will significantly sub-optimize. We, over the period of time, have embarked on a great number of international forums where we've gone out, told our story, we've made promises, ensured that we stuck to those promises, and were as open and transparent as we could in order to engender positive market sentiment and have economic actors believe in the framework in which we were setting out for the future of our foreign exchange system. So that all, I believe, has paid up quite respectively. Your second question, of course, how sustainable is this? And it's a very good question. How sustainable is this? Now, of course, there will always be risks to any outlook. There will always be risks to any outlook. We cannot underestimate the potential global shocks that could come our way. Nobody has a crystal ball. We can only project into the future, but who knows what tensions there could be globally that will come in and affect us in a way that we never anticipated. Oil prices, how those oil prices play out, we can only project. Importantly, of course, as pre-election spending, and that also, if not properly contained, can destabilize, the stability we've accomplished. And of course, fiscal deficits, we're in a new year, and I know that is something that is being looked at very, very, very carefully. And from our side, of course, we've got to make sure that we are consistent with our policy formulation and there are no policy somersaults. Net, my view is that as long as all things being equal, I believe that the trajectory we are on is one that is sustainable into the future. Of course, we know that there's every effort being made to diversify our base. And as all those things start to kick in, they can only but add to the situation we're in.
Good afternoon, Mr. Governor. My name is James Major with This Day. In January, inflation is to 15.15%. And inflation had been one of the greatest challenges for the central bank. Even when you came, you said of what use is growth if inflation is so high. Today, you have the CBN has reduced MPR. Can we now go to sleep on inflation? Thank you, sir.
Thank you very much. And thank you for reminding me of what I said 2 years ago. And that hasn't changed, to be frank. It hasn't changed. And having said that, caution is our watchword in the central bank. Caution is our watchword in the central bank. We are by nature a conservative group of people. And we have to be that way because we have to do everything possible to protect our economy. And where we see fragilities, we've got to ensure that we're doing the right things to protect our economy and to strengthen our base. Having said all that, we're encouraged, of course, by the fact that, again, going back to what you said, inflation at that time, 34%, we brought it down to where it is, slightly over 15 headline. We're encouraged by that. And we believe that a lot of the measures we have taken, though difficult, though tough in many respects, have begun to pay off. And part of that, obviously, is the monetary tightening. We've had no option but to ensure that we've kept a very, very tight monetary policy. We believe that if we sustain stability in the foreign exchange market, which we have seen in the recent past, that it is important to sustain that. We also believe that it is important that the sort of decreases we're seeing in food inflation should continue like that. We understand the structural rigidities, and we understand that the fiscal is doing everything possible to sort of balance things out so that at the end of the day, the collective will ensure that we continue on a downward disinflation pathway. But having said that, by the way, I must also emphasize that it will take a lot of discipline from all the stakeholders. This is not something that will be central bank alone. All the stakeholders will need to be involved, working collaboratively to ensure that the gains we have achieved are sustained.
Thank you. Mr. Governor, my name is Mark.
Yeah, well, I think we were just talking about what the CBN governor said finally there, the need for collaborative efforts if these gains would be sustained. Mr. Teriba, is this, you were expecting a very, what was that word you used? Drastic?
A demolition of the monetary policy barricades.
Is the 50% big enough to demolish the barricades that you talked about?
No. And the speech that the governor just made worries me greatly. I'm worried not by what he said, but by what he did not say. He told us, he's talking about likely increases in fiscal releases. Anybody that has been watching news networks in the past 3 weeks has seen federal MDA after MDA coming to lament how they did not get their capital allocations in 2024. They didn't get it in 2025. And they are unlikely to get it in 2026 because federal government has no revenue. Governor of the central bank here is talking about likely increases in fiscal releases. From where is that likely increase in fiscal release going to come from? And he's speculating about likely increase in investment spending. That's one. So there is some disconnect with fiscal reality from what he has said. Second, the governor of the Central Bank had just told us why they decided to ease by 50 basis points. He did not mention output growth. The closest he got to it is to tell me purchasing managers index in fourth quarter was 50. This is February. First quarter ending, nothing about output growth. And they took a decision on monetary policy. And they are going to meet after 3 months. Finally, what's the condition of the businesses generating the output? And what's the condition of consumers? The Monetary Policy Committee just met for 2 days and had nothing to say about the economy. The banking system is not the economy. Inflation is not the economy. Exchange rate is not the economy. Okay, you talked about reserves. So what about GDP? What about business investment? What about consumer spending? What about the welfare of Nigerians? Nothing.
But Mr. Teriba,
So that's the disconnect. If you are connected, if you are concerned about the fiscal situation, you are connected about real output growth, you are connected about business investment, whether they are liquid or not liquid, if you are concerned about consumer spending, whether the households have enough to eat or spend, you won't do 50 basis points. That's my point.
Mr. Teriba, the CBN, I believe they have those data because they do release business
They did not talk
survey.
about it. They just told us their considerations. They didn't mention economy. Inflation is not economy.
So they do share business survey data
They
and
did
all
not
of
talk.
that.
I know what they share.
Okay.
I am talking about what they talked about that led them to the decision they just took. If they spoke about fiscal situation where government is now 2.5 years in arrears with its capital vote, federal government, where you talk about output growth, talk about business investment, talk about consumer spending, you won't ease by 50 basis points. You will release the 45% CRR on which they pay zero interest to banks on their CRR. And then you are doing a special deposit facility at 22.5%. Then pay them interest on that 45% CRR instead of paying them on 2.5 trillion at 22.5. That's the point I'm making. If you are looking at the real economy, you will demolish those barricades on the banking system.
Mr. Mohammed, do you also agree that perhaps the CBN did not look wide enough before this 50% basis cut?
We have to go back to the history of our CBN. Our CBN are conservative, whether it's Emefiele, whether it was Sanusi, whether it was Cardoso. I have not seen a CBN that has come out there and faced the situation head on, like he's saying, and said, look, this is what should be done, and we are going to do it. Now, they have different method of trying to, I think the CBN is trying to manage inflationary pressure. I believe that, like he said, the 45% for the banking sector would have been released. But again, that's on that tool they want to use to control inflation. I believe so because it's looking at, don't forget that the banks are recapitalization and they are bringing in more inflow into the banking sector. Now, how will this inflow be managed is another challenge that the CBN, I don't think are prepared for. Because now what we will see when those inflow comes, you see that even it's already starting that the banks are telling you that most of the inflow we are going to get is to establish banks offshore. That, again, is a major challenge they are looking at. And when you look at the physical side that he is saying, talking about where he said, revenue will improve. I think he said it there stylishly. He's talking about the issue of the NMPC gas now coming directly to the
new tax reform.
Let's not go to the new tax return because there's still a lot of challenges that have to do. So when you're talking about the new tax return, are you telling me about are you talking about the real or the one signed in or the one not yet signed in? So we need to, because that also has challenges.
All right, Mr. Mukhtar, please, just a minute, because for our DSTV viewers, we have to lead you to the PGF Renewed Hope Ambassadors Summit 2026. It's taking renewed hope to the grassroots. That's what the theme of that meeting is. by the Renewed Hope Ambassadors. But that's for our DSTV viewers. And if you're watching on DSTV and you want to continue watching, please go to our YouTube channel. Just move to the next platform and you'll be seeing us right here. Mr. Mohammed, please go ahead.
So that's what I think the CBN is trying to do. They're trying to manage because, again, there's no synergy. That's why you see the CBN governor saying it has to take every side. You don't have to take every, I mean, if there's a synergy, you know what each side needs to do. As it stands now, whatever we've achieved thus far, as regard our economic prosperity or stability that we are enjoying now, was largely driven by monetary policy tools. Because the physical sides are the ones to make the impact of the monetary policy decision felt by the people. Now, but if you are still in a government that is still thinking of borrowing more, we are still having, you see, when they say inflation has come down, then you come to the reality. You look at cost of transportation as it come down. Just yesterday, the government rapid system in Lagos State will be increasing by 13%. So does that tell us the reality on the ground? Does that really tell the market woman will tell you that you say inflation has come down, but the cost of goods and services has not come down drastically? Now, if INI and Dr. Tereba, you have cars, so you are the one enjoying the reduction in terms of fuel consumption, because the man that is still entering the bus is still paying more transport. The transportation has not come down. At when fuel was 1,200, it hasn't come down to lower when price has come down to 700 or 800 averagely. It hasn't come down. So we need to look at it is when you are talking about, like he said, economy is not just about the inflation and everything. What about the people? But my challenge is that if you talk about the people, the monetary policy will tell you, like he's talking there, he says, it's price stability I'm interested in.
That's their core responsibility.
That's their core responsibility. He's telling you I'm interested. So it's
price stability is a means to an end.
Yes,
it is not an end in itself.
It will not be driven by CBN.
The end is for the economy to grow, for Nigerians.
But everybody have their role.
Everybody has their role.
And the monetary
so
talk
to us, by all means,
no, you know, we have a child.
By all means, talk to us about price stability. But don't be silent about
I think that
the
is why,
ultimate reason why you need
at the end there, the CBN governor did talk about the need for all authorities to be disciplined.
Let me talk about the CBN. You know, when they came in, it was a mess, chaos, and they were confused.
Which I acknowledge.
They were confused. Now, remember he said something there when he came. He said, we are going to have a competitive currency.
Yes.
And he came, now we have a competitive currency. He now said, the next time he met, he said, we are now working towards a stable currency. Now, if you look at the way he's talking about price stability, competitive currency, stable currency, we are getting
all very necessary.
Very necessary.
But when
when you talk about the real economy that should be felt by me and you,
correct,
then we need to also look at the 3 tiers of government that have been able to get good allocation, improve allocation.
Good.
But they have not really translated that to the average Nigerian. So it's not in the place. The CBN will only do what they have to do. Now the physical side must do what they have to do.
Don't get me wrong. If you give me 10 seconds, I should clarify myself.
You have more than 10 seconds.
Okay, thank you. The CBN is the one with which we have charged with management of liquidity and prices, so that economic activity can be adequately funded. So you are the manager of money, but money is not demanded for itself, it's a derived demand. Mm-hmm. So how much I earn is more important than how much cash I hold. Because at the end of the day, how much cash I hold can only make sense based on how much I earn. So you shouldn't come here and talk to us about decision on monetary policy and then talk about banking system, foreign exchange market, inflation exchange rates. You talk about reserves. But I never mentioned the ultimate reason why banking system is important, why foreign exchange market is important, why exchange rate and inflation is important. Okay, yeah, there was crisis with reserves, 4 billion net reserves to 30 billion net reserves. That's good, that's commendable. Yes, exchange rate was volatile, it's now stable. Yes, inflation was accelerating, now it's decelerating. We clap for you. But don't tell me about the decision you meet again in 3 months. And you have not mentioned the fiscal liquidity shortage that makes capital projects can't be funded. You've not spoken about growth and how you want to relate your monetary policy decision to ensuring that the requirements of growth are met. And you didn't talk about the business sector or household sector. Let's not even talk about employment, which you should talk about. You didn't talk about those things. How do you want me to feel comforted that all you care about is just inflation, exchange rate, and banking?
So Mr. Tariba, would you prefer that? I mean, this is MPC, and all over the world.
Listen to any other MPC anywhere else in the world. They are not going to read any speech without talking about real economic activity. That's why you exist. Without that, we don't care.
Okay, so you're saying that before the MPC, the committee come out to make announcement, they should have meetings with the fiscal authority?
No, not meetings, reports. Report fiscal conditions and how monetary policy should relate to it. Report real sector condition and how fiscal monetary policy should report household condition. That's what you exist for. That's my point. So I'm not, I will be first to commend the progress to date by saying that if you could spare a thought for the fiscal funding shortage, if you could spare a thought for the weak, output recovery that you need to sustain and support, if you spared a thought for households who increased mass, prices was dropping, people, the motor parks and the markets were empty, you will relate monetary policy to that, then you will demolish that barricade. Then you won't leave 45% cash reserve requirements there and be mopping up through special deposit facility at 22.5%. You would think about the real activities that you need to. You trade it off with balance, with concerns about inflation and exchange rate. That's the point I'm making.
Okay, Mr. Mohammed, I mean, you have been following, MPCs even before Mr. Cardoso. Was there a time that, this perspective of what Mr. Tariba shared, was there a time it was infused?
I can't remember. I don't think so.
Can I quickly respond to
Let him
wait. Sir. No, why should he respond to an issue that I raised? I wrote an article.
Okay.
In 2012, when Lamido Sanusi was there, monetary policy, the need to resolve Nigeria's monetary policy conundrums. Okay? This problem had been there long before long before Cardoso.
Yeah, but
that monetary policy just talk to us about banks and foreign exchange market. They will not talk about the economy. And now that we are having an economic reform, we need to get them to do so. It's not the first time I'm writing in public or speaking in public to say that we shouldn't let the Monetary Policy Committee get away by talking about financial markets and prices and not talking about the economy. Economy is important.
Okay, so that means what you're asking for is a change, Mr. Tariba.
A change in the way we present our monetary policy.
The way we do it.
Yeah, but again, like I think in other developed economy, yes, they will talk about the employment rates. They will talk about how it has improved, consumer spending and everything.
Credit conditions.
But in our own term now, he is talking about in terms of stability in price, which he thinks have also helped drive down micro. He is not coming out categorically to talk about that consumer this thing has improved. But from what he's saying, from what the companies, from the numbers we are getting from companies and everything, it seems that especially when you look at the conglomerate, when you look at conglomerate like most of the conglomerate like the manufacturing sector that has also been very high yields by this during the we call it the floating of the currency or whatever, you can see that there seems to be a little bit of stability in that space, and consumer index production have improved because people are now spending a little bit better than what it was 2 years ago.
Granted.
So he can, by virtue of that, say that consumer spending have improved. But again, I agree with what he's saying in the sense that you need to back it up with data and how will you. But again, in a Nigerian context, he's saying it there and he said it categorically. It has to take all of us to be disciplined. Now, when it comes to that aspect of physical discipline, that is where I have my challenge with the executive arm of government. Because when you talk about physical rascality, it's highly displayed by the executive arm of government. All you need to do is to go to the street of Lagos and see an entourage of a governor and how many cars are driving with that governors. So all this, you need to go and see governors traveling for doing white elephant projects in a state that does not, in a state closer to Lagos, and Lagos have not been able to even generate more inflow in terms of passengers to their airport. They are trying to build a new airport. All these are not going to enhance the life of your people. No matter how much is released from the executive arm of government, if the people in the grassroots, the local government people, those people in the state are not feeling the impact, then whatever the monetary policy tools are saying, or you tell the average person that, look, things have improved, it will tell you how. And that is not going to be driven by the monetary policy. Fiscal policy has to come up with incentive. If you are talking about agriculture, you want to reduce price of food. How do you help the farmers? That's why I agree with him in terms of lending. Even if the lending rate has come down, has it really come down for the formal sector, the informal sector? Do they even lend to the informal sector? When we are talking about lending rate, people think the woman that is selling pepper goes to the bank to get loan to improve his pepper selling. It doesn't. When you talk about lending rate coming down, you are looking at the bigger conglomerate, the formal sector. But this economy, Nigerian economy, is not driven by the formal sector. They are not the largest employer of labor. The informal sector, how are you going to galvanize the SME? Yes, you have brought stability in terms of exchange rate, but now, physical side, where are the tractors for the agriculture so that the cost of goods will come down? Where is the security so that I can move my goods from Maiduguri to Lagos without paying duties in every state I enter, levies to every state I pass in? The new tax law hasn't been able to address that levies that the market woman is paying in my street. So all these are physical policies that should be driven by the physical side, not the monetary side. So I agree with him totally when he said that, okay, no matter what the monetary policy committee does, if the physical side is not in synergy with what they are doing, it will make a mess of whatever they are doing.
So would you still say, I mean, we've been talking about this for years, about the disconnect between the fiscal and the monetary authorities. And we've heard Mr. Cardoso, especially at the beginning of his administration, talk about the efforts to connect these two. Would you still say that disconnect is still there, largely?
It's there. Unfortunately, it's still there. And again, when you have Cardoso, then you have a minister for economy, which also should be somebody they have worked with before in Lagos State, and you're still having that disconnect. Then you begin to say there's a structural problem with the Nigerian economy.
Mr. Terba, how do we overcome this structural problem?
Well, he calls it structural problem. I call it a disconnect. But the central bank and its monetary policy committee are living in a virtual world, unconnected to the reality of the economy and of the fiscal situation. So you have a federal budget in crisis of near zero funding for capital projects. Well, you just read your speech and you reviewed conditions in the world economy, but no mention of that poor funding of fiscal capital budgets. But we speculate about what politicians may or may not.
It's don't hold him forward for him. He will tell you, they will say the new tax law is there to improve revenue. Like
exactly.
You say.
And then the NNPCL direct remittance.
He even made mention of it. He said the executive order 09.
Yes.
He believed that will improve fiscal
revenue. Yes.
Between you and I, new tax law, the executive order, will impact federation account, not federal budget.
Exactly.
We are talking federal.
But no. When you look at federation account, it will still boil down that the federation account that is there, federal government will definitely have some share.
Very good. The financial system is disconnected, from the realities of GDP growth, requirements of investors, requirements of households, requirements of consumers. And they have no other agency to relate and solve their liquidity problems. And you are locking up 45% of banks' eligible deposits in CRR. And you, before this meeting, you've mopped up, they say 2.5 trillion at 22.5. Why? Because of that disconnect. So you could call it structural. I'm saying it's a disconnect. Let them reconnect.
How?
Look at the gap. Look at the gap. Wait. Look at the gap between the MPR and the Treasury bill rate. In the last couple of weeks, as you were encouraging banks to come and leave money in the special deposit facility window at 22.5, federal government was issuing new instruments at 17.5. So look at 17.5, compare it with 27%, now you have reduced it to 26.5%. It's a disconnect. You trade in that federal treasury bill when you buy, you discount, you do open market operations at 17%. Banks that you are imposing 26.5 on trade at 17%. It's a disconnect and it's a joke. So integrate, let the banking system reconnect with market realities.
They will tell you that if you look at the bank balance sheet, you realize that a lot of the banking sector tend to go to get most of instead of just lending this money to the real sector, because of the instability in the economy, they rather put it in that 22.something% and just lock it up there and then add it to their revenue. You could say that, okay, if you look at it now, is it safer to you to lend to the real sector to get more than put it with the bank? It could also be an argument that he can fight.
So the MPR is 26.5, but what's the real interest rate that the real sector faces? I don't think they're normally 26 or whatever is announced.
Can I answer that? The realistic interest rate that the economy faces at the moment is meant to be set by the CBN, but no. It's set by the government treasury bill market, where the central bank is an active participant, rediscounting at those rates. You are supposed to be the rate setter, but you become a rate taker. So reconnect, wake up. Anytime that the MPR is more than the rate at which you are either issuing or discounting in the government treasury bill market, then you are disconnected. And you are supposed to lead the market. Not for, you've left the MPR at those elevated levels now for 2 years. And people are asking whether you will ease or hold. And you are coming to do 50 basis points. When the market is 1,000 basis points below where you are. And the realism is the market. Everybody has access to the government securities market. Households, including the banks, anybody, and the foreign investors. Everybody knows that market reality is somewhere around 16%. And you are still doing 26 points, and we then justify. Yeah, we are talking of structural. We are talking of...
Mr. Mohammed, you deal a lot with the market. What do you expect with this 50 basis points cut?
Well, like I will say, it depends on which sector of the market you are operating in. If you are in the financial sector, if you are the banking sector, you will see, okay, that means my borrowing, my lending will come down. How much I'm lending to people, so that could also affect my bottom line. If you are in the manufacturing sector or the conglomerate sector, then you'll be excited that your lending has come down. So we need to see the impact. Ordinarily, a cut in rate is a positive impact to the market. But again, it's a positive impact to the real market. When you talk about the market, you talk about the stock market and all that. But again, like he has pointed out, if you realize over the months, the fixed income market the rate has been going down. Especially, like I said, the government issues have been going down. And so that, again, is also, that means normal investors that don't take risks, like to go to that fixed income market. But again, you can also substantiate that saying inflation is about 15.1%. So if I'm giving you 17%, I'm still beating inflation. So that's why I say it depends on which side of the market you are. But ordinarily, a rate cut anywhere is positive to the market.
So is 50 basis points big enough to make any impact?
I'm not seeing. Sometimes I want to agree with you when it comes about the disconnect between the monetary policy and the market itself, because I need to stand corrected, because I've never seen a connect between a cut of rate or a hike of rate reality on the market, to be sincere. The reality of that, a rate cut is helping the market, or a rate hike is I've not really seen that connection.
Because this rate cut
I've not seen
is
it.
not for
is that because of the disconnect?
It could be because of the disconnect, because again, you look at the rate cut. Ordinarily, you should, like I said, we had a stable rate, and you saw the market was still going the way it was going. We have a rate cut today. We'll wait to see what the market will do tomorrow.
Very good. A rate cut for who? That rate cut you refer to is only meant for banks.
But don't the banks give credits to the private sector? Shouldn't it reflect?
Never mind.
Which private? Which private sector?
Private sector have access to the treasury bill market. They buy, they sell, and they can rediscount. They will get their money at 20% in the treasury bill market if they went to the rediscount window. So who cares about 26.5% that the
But again, the private sector also have come up with their own.
Who have liquidity shortage,
the commercial paper, which is cheaper fund for them.
Anybody.
Yes.
So now the market is somewhere. Central bank is in virtual reality, and they need to be aware of the market.
So now, the central bank governor has said that the next meeting is in May. That's in 3 months. What do you think we would see? What could be happening with this 50 basis points cut down 3 months down the line?
Let me tell you why. Well, central bank has other ways of influencing the economy besides its monetary policy instruments, because we give them a lot of credit for progress with the foreign exchange market. That has nothing to do with monetary policy committee. Progress, with banks, access to the foreign exchange market. As we speak, from 31st December to date, the Nigerian Stock Exchange, the market capitalization has grown from 99 trillion naira to 125 trillion naira as of yesterday. If you talk about liquidity creation, that's issuance of equity. The market is 26 trillion better off, regardless of what central bank was going to do today or what they are going to do in the next 3 months. So what liquidity can the central bank provide you in the next 3 months that is going to be more than that 25 trillion that we've seen in the stock market? So if this trend continues, 2026 is going to be a repeat of 2006 in the stock market, when we saw the market capitalization double. And between 2006 and 2007 December, we saw the market capitalization rise from 2 trillion to 13 trillion. I'm saying we are back to that trajectory. Anytime you see the naira appreciating significantly against the US dollar, market liquidity will surge regardless of what the central bank does. So this time, when in 2 months the stock exchange has issued an additional 26 trillion, and you want to go on break for 3 months before you come back, if we extrapolate that, the market would have created another 40 trillion. So what's your 0.5% easy? What would that do?
I think
in a market like that.
I think the situation we have now in 2020, 2006 and 2007 could be really very different compared. I mean, we look at the equity market. If you look at this,
in your opinion, wait. I'm demarcating it. In your opinion, you are saying it will be different. In my opinion, I'm saying it will repeat. So
okay.
You may
continue.
Right,
so why I'm saying that it's going to be different is that Whatever you're seeing in the market today is driven by the market unlocking the liquidity in the pension fund.
Yeah.
That has not been there before. The government improving upon that, that those pension fund money can find their way into the market. That is also what is helping the growth in terms of demand that you are seeing in the market. And when you look at that time, those pension funds then and now, we are looking at the pension fund sector that is coming for the long term. You're not looking, and this at 2020, 2006 and other, you saw a market that was largely driven by foreign investors. This time, you are seeing a market that's largely driven by retail investors. So
that's why it's important.
It's a big difference.
It's a very big difference.
In your opinion, and I ask you, how much is the pension fund itself?
I think the pension fund
is
a
about
major
26
and
trillion.
the market has already grown by 26 trillion in 2 months. So how can the market grow by the size of the pension? So
the pension
one explanation. One
major drive. We have other major drives that are coming. The investors are still there.
That whenever the exchange rate, the Naira exchange rate is favorable against the US dollar, money is coming. It's going to come into the stock market.
So you think it's the foreign,
it's going to come into the bond market.
Hang
on. Don't ask who I think. It's going to come into stock market. Let me land. You have to let me land. Okay. You are going to see the stock market at least double this year. You are going to see the bond market. Can you let me land? You are going to see the bond market. You see how much government has issued, whether for the power sector or their monthly issuance in the bond market. And the banking system itself will double because the exchange rate of the Naira is strong. It makes those Naira assets more attractive than their dollar counterparts. So it's going to come from everywhere in which pension fund is included. So you are going to have more FPI, who is going to deposit money in banks, who is going to take government bonds, who is going to put money in the market. Over and above, there's no way pension fund is going to explain 26% increase in market capitalization in 2 months.
All right.
February has not even ended.
All right, thank you so much. What a passionate conversation we've had here with the Chief Executive Officer of Economic Associates, Mr. Ayo Teriba, and of course, the Chief Executive Officer of Finance with Mr. Mukhtar Mohammed. Thank you so much, gentlemen, for being a part of the program and sharing your views and passion with us this afternoon.
Thank you for having us.
It's a pleasure.
All right, so that's it until May 19, according to the CBN governor. That's the next MPC. And of course, we would see the impact of these 50 basis points cut. But you know, right here, we're going to continue this conversation on the impacts of these 50 basis points tomorrow morning, business morning, and every day we'll find out how this will impact the market, the real sector, and all. I'm Ini John McCraw. Thank you so much for being a part of this journey with us.